Hello from all of us here at Robert and Jones. Hope you're well. Hope you had a great Thanksgiving. We just wanted to take a little bit of time to give you a quick update about our upcoming rebalance. This is an opportunity for us to also kind of change our allocation based on some new data that has presented itself. Now, the biggest thing that we all have heard about is inflation, and that's also the biggest change that we're making. We're adding about 2% or so into our 50/50 model, which I'm using as kind of a benchmark or an example. Um, we're adding about 2% to TIP, which is a inflation protected treasury position. But we're also adding about 2% to a short-term inflation protected treasury position. That's really to mitigate interest rate risk. We think that within the next 12 months, we're going to see the Fed raise interest rates to help combat and to help fight the inflation. But we want to keep things short. So we want that inflation hedge, but we don't want a lot of interest rate sensitivity, which is why we're adding that short-term treasury position. Um, on top of that, on the equity side, uh, we are eliminating most of our Chinese exposure, all of it, as far as we are concerned. And what that means is that we're really reducing our emerging market exposure. And there's a lot of risks out there, especially through the Chinese exposure, political. There's debt crises that are emerging, and we're really taking the proceeds of that emerging market, and that's going to be that ESGE that you see there that's coming down 2.91. Um, those proceeds are going to be reinvested into the S&P 500. We're seeing a lot more good news and a lot better prospect in the domestic market as opposed to, or when compared to, the emerging market sector as a whole. On top of that, and one more on top of, we're going to be adding to FALN. So you'll see about a 4% increase from our current allocation, and that's really kind of an opportunistic trade. It's got a higher yield, so when yield is hard to find, we're adding to it. But this portfolio is all companies that were investment grade that have been downgraded to high yield. And most of these it has been from an effect of the pandemic and the government lockdowns. So normally when those kind of shocks happen, it takes a little bit of time, but a lot of those companies regain their investment grade status. So that has taken a little bit longer this time around, but I think it's more on rather than the quality of the companies, I think it's more on the hesitation or hesitancy of the Standard and Poor's and Moody's, the rating companies, that I think they're a little more hesitant to just move them right back up to investment grade. So as we go into 2022, we are excited for what the months to come will bring, but at the same time, we're hesitant. We are at all-time highs after all across most markets. So we're really taking risk off a little bit over in all of our portfolios, adding inflation protection and going into 2022 well positioned. So let me know, or let us know, if this was helpful to you, and we look forward to seeing you soon.